Canada, a vast land rich in oil, natural gas, and minerals, is like a treasure chest of energy for North America. For years, it has acted as a safety net for the U.S. economy. President Trump once remarked that Canadians were paying less than half the taxes Americans were. When asked about tariffs on the EU, he responded, "Absolutely." At one point, Trump imposed, and then paused, tariffs on Canadian goods. But today, things are changing. Washington's protectionist trade approach is pushing Canada to shift its focus toward Europe and Asia. What could that mean for the U.S.? If Canada, America's largest energy partner, starts looking elsewhere, the U.S. could lose a key advantage. Canada's new trade deals with the EU and Asia are changing the global trade landscape. If Canadian oil, natural gas, and minerals start flowing more to Europe and Asia, the U.S. could lose jobs, energy stability, and even global influence. But is the U.S.-Canada energy partnership really at risk? Or is it too vital to fall apart? Over the past few years, the global energy market has shifted, and Canada is now a central player. With vast reserves of oil and gas, energy trade between Canada and the U.S. is crucial for both economies. After saying the U.S. had been treated unfairly by many nations, not just Canada and Mexico, Trump announced a 25% tariff on Canadian goods. That move pushed Canada to deepen ties with Europe and Asia, aiming to diversify its energy exports. Canada is the U.S.'s biggest energy supplier, and the second largest buyer of U.S. energy after Mexico. Despite the U.S. being a top oil and gas producer, it still depends heavily on Canadian heavy crude to power its refineries. Canada now provides more than half of U.S. oil imports and nearly all its natural gas imports. It's also the top supplier of electricity and critical minerals like uranium to the U.S. These ties are essential to American energy security and price stability. Trump's tariff threats, 25% on Canadian imports and 10% on Canadian oil, rattled one of the world's closest free trade relationships. Canadian leaders were stunned, but rather than back down, they've responded by expanding their global reach. Canada now plans to boost non-U.S. exports by 50% by 2025, as part of a broader diversification strategy. The European Union is actually one of the world's largest economies, and it stands as Canada's second biggest trading partner. Through the Canada-EU Comprehensive Economic and Trade Agreement, or CETA, Canadian companies have gained special access to European markets and some major growth opportunities. CETA was signed back in 2016 and has been provisionally applied since 2017, but it still awaits full ratification. The agreement eliminates most tariffs, covers a wide range of services, and encourages the alignment of rules between the two regions. It even allows companies to bid on government contracts across both Canada and the EU, opening up a market worth about $3.3 trillion to Canadians. But not all EU countries have signed on. 10 nations, including Italy, Ireland, and Poland, haven't ratified the deal yet, citing concerns about corporate influence, food safety standards, and protections for local agriculture. And in some cases, it's just not really a political priority. Brexit made things even more complicated. The United Kingdom had been a strong supporter of CETA and was actually one of the first to ratify it. Now, Canada and the UK are temporarily following CETA's terms, while they work out a direct bilateral agreement. Amid threats of a trade war from the Trump administration, some argued that Canada and the EU needed to speed up CETA's finalization and encourage more businesses to take full advantage of it. So what happens if Canada shifts its energy exports to Europe and Asia? Well, the United States might lose easy access to Canada's affordable and steady energy supply, which could potentially raise domestic prices and weaken its energy security. Stronger Canadian ties with other regions could also reduce America's leverage in future trade negotiations. Still, even when tensions have run high, Canada has managed to sign new commodity agreements with the U.S. and other partners. But Canada really has to act strategically to protect its economy and remind Washington just how much it depends on Canadian resources. By investing in key resource sectors, Canada can drive industrial growth, boost its GDP, spark innovation, and attract more investment. This kind of approach would encourage domestic development and further cement Canada's importance to U.S. energy plans. Targeting strategic resources can also help revive Canadian manufacturing, while still meeting important sustainability goals like capturing methane and reducing emissions. When the U.S. imposed a 25% tariff on Canadian steel and aluminum, it was a wake-up call for Canada about the need to diversify. Selling to other markets would help reduce risk and increase exports of agriculture, raw materials, and energy to Asia and Europe. In the long run, this could really grow Canada's trade with the world's largest and fastest-growing economies. Even Washington seems to quietly acknowledge Canada's importance. Its lower, 10% tariff on Canadian energy, as opposed to 25% on other goods, was a subtle admission of that fact. So how do Canadian oil and gas support America's energy strategy? Well, Canadian exports really strengthen U.S. reserves, help keep prices low, and support U.S. ambitions to export energy to allies. The two countries' energy systems are, deeply integrated. Any move to split would be slow and costly. Although the U.S. is a net energy exporter, it still wants to help Europe and Asia reduce their dependence on less reliable suppliers. Canada is, honestly, essential to that effort. Meanwhile, as demand grows, especially from energy-hungry AI data centers, Canada's stable supply is more important than ever. Cross-border pipelines and power grids allow Canada to support the U.S. without raising fuel prices at home. But there's a twist. Canadian oil might limit America's bid to become the world's top swing supplier. Canadian crude now accounts for a quarter of total U.S. oil use. Refineries built for Canadian crude would need expensive upgrades to switch, or risk depending on more volatile sources like Venezuela or the Middle East. Canada's Trans Mountain pipeline expansion has nearly tripled its export capacity, enabling more oil shipments to partners like Japan and South Korea. Canadian natural gas also helps the U.S. maintain domestic supplies, which supports more U.S. energy exports abroad. With demand for gas projected to outpace supply, especially as AI and industrial changes stress the grid, Canada is well positioned to step up. It already supplies about 9% of U.S. gas needs, and with 6 LNG projects on Canada's west coast in development, including LNG Canada Phase 1, launching this year, it's on track to become one of the world's top 5 LNG exporters. Canadian electricity also plays a growing role. While the U.S. produces most of its own power, Canadian imports keep prices low and the grid stable in many states. One example, Hydro-Quebec's Champlain-Hudson Power Express, which aims to supply up to 20% of New York City's electricity. This could save local residents $17 billion over 30 years. With more than 30 cross-border power lines already in place, Canada is a key part of U.S. grid security, especially as AI expands. By 2028, data centers could use 12% of all U.S. electricity, up from just 4.4% in 2023. Canada's help may be essential in meeting this surge. So is Canada's role purely economic, or is it something more? Its quiet but essential contributions could redefine global energy security and shift the balance of power. What do you think this means for the future?